FTX collapsed this month in the largest financial scam since Enron. FTX, led by CEO Sam Bankman-Fried, was the second largest crypto exchange by volume, valued at over $32 billion. They were expanding worldwide at a rapid pace, banking sponsorships with the MLB, NBA, and esports, alongside partnerships with a long list of celebrities. They made large donations to Democratic parties, notching themselves at the second largest donators in the world, and were working closely with Congress to pass favorable bills for themselves within the industry. That all came crashing down this past week. The spark that ignited the explosion was a CoinDesk article sporting a leaked balance sheet of FTX and Alameda, Sam's trading firm, that worked alongside FTX. The alleged document showed that FTX had assets of $18 billion. The problem was that the funds all resided in coins that FTX owned the majority of the supply. They could artificially inflate the prices of these assets to make their balance sheet larger and borrow money off these assets. It became clear that in order to pay their customers, they would have to sell these assets and receive pennies on the dollar. In essence, they were heavily in debt. Once users realized the situation, they quickly began to rush for the exit, leading to FTX's largest outflows ever. Shortly afterwards, FTX paused withdrawals as Sam tried to calm everyone by tweeting out that they had the funds to make everyone whole. Within 24 hours, he again tweeted that FTX was filing for bankruptcy. After the dust had settled, it became clear that Sam was taking FTX user deposits and sending them to Alameda. Not only did the exchange not buy the coins its customers were purchasing, it sent the funds out to be gambled with, used for political donations, exchanged for properties in the Bahamas, and loaned out, in particular to Sam, who had taken out a $3 billion loan from Alameda. It is also alleged that the trading firm Alameda was also using FTX user info to trade against its users and would purchase coins before they were listed on FTX, profiting off the spike in price. To make matters stranger, the CEO's parents had close ties with Gary Gensler, chairman of the SEC, and were working closely with regulators to try and minimize risk in the crypto industry, often citing the problems of the 2008 financial crisis. They attempted to pass bills to stifle the crypto industry, but that would essentially give FTX a monopoly over the industry. They made enormous donations to Democrats, Ukraine, and even a few Republican figures. In the end, the biggest risk was right next to them, funneling user funds right into their own pockets. Within a week, the firm, valued at over $32 billion and with 1 million users worldwide, collapsed to zero. Currently, the bankruptcy filing is ongoing, and no arrests have been. Sam has been seen casually strolling around the Bahamas tweeting about the affair. No comments have been made from regulators who continue to push for regulation that Sam helped create.